Just want to let you know that we just finished up our performance on options on futures, and I'm not very happy with it. You guys can jump into the options on futures channel. You'll see the performance there. Was doing good at the beginning and kind of went downhill for a little while. So I'm going to be putting a lot of focus on this trade in the coming months, just like I did with 0DTE when it was not performing almost at all. And now we really do have a vibrant, awesome 0DTE strategy that's working well. And I plan to apply the same kind of techniques that I did with 0DTE to options on futures. So hang in there. It's going to get better, I promise. So with that, let's get going. What are you going to learn today? Understand the differences between SPX option trades and options on futures trades. Secondly, how to identify the strikes, strike prices, and the spread width of ES futures. And how to identify the intraday setups that yield quick directional trades. You probably have seen those here and there this week. The best time to trade 1DTE and how to mitigate 0 and 1DTE options on futures trades. So these are different than SPX, and we're going to highlight those differences are. What is the ES options credit spread? It is a credit spread of 2 puts and 2 calls. They're verticals, just like SPX. The call that is sold, and this is a credit spread, so it's the call that is sold is more expensive than the call that is bought. So you enter with a credit into your account when you put on this trade. Okay, here's the construct of the trade with toss, think or swim. So this is how it works, and we're going to go over all these, the construction of these trades in a minute here. In this case, we're selling the 3715 and buying the 3700, and the trade is considered a high probability trade. So here's the breakdown of the trade. First of all, the number of contracts traded. Secondly, the spread, which is a vertical. And then this is the futures contract. I think it changes every 3 months, but right now we're in the September futures contract. The multiplier is something that's very different because, a lot of people say, oh, it's S&P 500. And when they see the trade, it's 100, they think it's 100 stocks, but it's actually the multiplier. So the multiplier for ES options is actually 50. Don't know why they did that. Maybe they wanted just to be differentiated from the others. But it's a 50 multiplier instead of a 100 multiplier. Expiration is that portion there, and it's kind of funky because it gives you week 1, week 2, those weeks, and then on the weekend there's a different view on that. Okay, so not sure why they did that either. It's just strange. Futures contract extension, that's my definition because I couldn't figure out where that was coming from. Maybe somebody here would let me know, but I haven't figured it out yet. And then we have the short strike, the long strike, and the actual option, the option type, and then the premium that you get. So it's 125, cut that in half, and that's what your premium is. Okay. So the credit spread risk reward is just like SPX. It's terrible. The risk reward is, so in this case here, it starts with 500, again, the multiplier. And so you can trade lots that are smaller than SPX. So that's one of the benefits. And then you can see the risk reward here is just like SPX. Max loss in this case is 437 minus the 6250. Okay, so options decay from 68 to 33 days, the rate of decay is 34%, 57% from 33 days to 5, and 5 days to expiration. And we are trading 1DTE, so it's even faster. A little bit more than 0DTE. In any case, it's a great trade for overnight trade because there's no overnight risk on this trade because you can close it out in the middle of the night if you need to. The profitability factors for profit, applied volatility, just like credit spreads, theta, which is the decay of the premium, and then the market direction. We do use this for a market direction trade as well, typically in the afternoons. It works pretty well. And then we push on the other side and you get a nice little gift for starting the trade out through the rest of the night. Sometimes it works the other way, but in any case, I try to do that most of the time to get that edge going. So let's talk about the strategy now. Let's compare the differences between SPX and ES. So first of all, I just mentioned overnight risk. There is that risk for SPX, and ES, since it trades overnight, trade. There's no way to put stops on this trade. There's no way to close it out other than putting either a market order in or a limit order. So no overnight risk for this trade. Multiplier 100 and the other is 50. Greater margin requirement for SPX, as we mentioned, so less margin requirement, 1,000 for a 10 wide. For the same, it's cut in half. So ability to roll into later expirations for SPX, that works. For ES, it does not work. It does work if you're using the same contract. So you can roll up or roll down the trade if it's in the same contract, but if you want to roll it to the next contract, then you cannot do that with a roll. You have to close the trade and open up the new one. Cash settled, SPX, futures contract settled some of the time, and cash settled some of the time. And the reason for that is because when the futures contract is within the spread and it gets closed within the spread, you'll be assigned a futures contract, an ES mini futures contract. If it's out of the money, obviously it's cash settled. If it's completely out of the money, in other words, it's a max loss, it's cash settled as well. It's only in that spread where you'll get assigned a futures contract. It happened to me a while back, and that's what happened. Do you always close the trade out? Yes, I always close the trade out. And the reason is because when you put on this trade, and we'll talk more about that, I put it on usually around between 2 to 3 o'clock or 2 to 3:30. And when you close it for 10 cents, you'll typically get that closure on a normal day. You'll close it out around 12 or 12:30. So you don't want to wait until expiration. Time is risk, right? So you don't want to wait until the end of the day in order to close that out just to get a few dollars back. It's not worth it. It's not worth it. So I close it out. And it's kind of the same thing for 0DTE. So if you close it out at 10 cents, you'll probably get it around 12 o'clock. If you close it out for 5 cents, you'll have to wait around till 3 o'clock in the afternoon to get that 5 cents. So let's look at the contracts here. So this is an SPX contract. You can see here that's 38.40, 38.30, and it's an 80-cent credit. And then you have the ES options on futures position. And so at that time, the contract was 20 points difference from SPX. So in this case here, for the same width, 10 wide, you get a credit of 77.84, and the credit for the other contract, for the ES contract, is 51.36. So you get less premium, but you also get additional buying power. This costs you 921, the margin minus the credit that you receive. And for ES, you get half of that. What's not a benefit is that the cost of these trades, the commissions, are more expensive. And so you can see here, this is $250 for commissions for each contract, plus $1.14 for the fees. And it's not per contract. I'm sorry, cut it in half because you're using a spread. And so for SPX, I have a 50-cent commission and 116 for the fees, right? So it is more expensive. However, there is a benefit. It's less margin than SPX. Okay, so that's kind of the give and take. All right, so now let's compare apples to apples on these. So now I'm going to start with the same thing, okay, that we just had, but I'm going to widen the width of this position over to 3. So now this is kind of like apples to apples, okay? Because now you're getting basically the same credit because the multiplier, right? So now you get $80 per contract, and here you get $80 per contract. The same. But the good part of this is that the premium is basically 2% difference, and you get 20% more buying power on this trade. So if you're trading SPX, 20% less of the buying power that you have compared to ES. Okay, so that is one of the benefits of this. Okay, let's look at the trade plan. When I put on this trade, I do like to put it on around 2 o'clock. And so the reason for that is because there's things that happen around 2 o'clock in the market. Volatility goes up and then there's more swings. And that's where, if you can look at it technically, I try to get in to where we get an advantage, right? So try to put on one side, get that favorable, and then I'll put on the other side. Doesn't always work that way, but that's the way I try to do it. The premium for the bull side is lower than the call side, typically, just because distance from the market is less for calls than it is for puts. However, lately it hasn't been because there's been a lot more premium on the call side just because, the market has been going up a lot. And so it doesn't make a lot of difference. Okay, so take profit is $10 to 5 cents. And then if a trade is threatened, used 2x and 3x, and I violated this, several times, and I am not doing it anymore. But in any case, I do try to get out. And so you can roll this position as well. Just wait 20 points before the breach possible, and then close it, and then put on a new trade for the next contract, depending on where that threatened trade is. So at times what I'll do, I'll have a favorable and a threatened side. So I'll close out both, and then I'll place where the threatened trade is, I'll place it higher or lower, depending on where the market is, to get additional credit after the loss. And then I'll put on position that wasn't threatened, and I'll add credit on that side. So that way it'll reduce the amount of loss that we have. So you close the threatened trade and open a new trade with a net credit. That's ideal. So let's go through some of these trades. And these were, a while back. Okay. But I'm going to show you the good, the bad, and the ugly in here. So this trade here, I started at 5 a.m. I placed a 39.80, 39.95 call, and then I placed the put. If you're looking at this, you can see here that it's backwards. It should be the other way around. So yes, I put on this trade when I thought the market was going to go down, but it did go up. And then I placed the put side higher than the call side. So it should be the other way around. So with this trade here, what happened, I closed it out because the market kept going higher on the call side. When the market went down, everything was in the wrong direction. And so I closed it out at $3. And so in this case here, there was a $265 loss. So it's not a huge loss if you trade it this way and use a 3x credit, but I have gotten into trouble where I've gone past that and should not do that. So I did put it on at 324, and then 130 was the credit, and then I closed this trade when the market went up, and then I put on a new trade, collected $1.10, closed that trade for 5 cents. And you can see here it kind of went up, went way down, and then went back up again, and I was able to close the trade for a profit. And then I sold a new one at 120, and this was, I think, was a directional trade. And I closed it out for 60 cents. That was a pretty successful trade day. Okay, here at 6:07, so it's right after the overnight session, I put on a 37.60, 37.45 put. I placed the put spread at 6:07, and then I placed the call spread at 3:58. Now I don't usually do that, but I was I guess awake at night, and I saw this and tried to get in. Right. So the call side worked beautifully. It went down and got out. And then on the sold another call side. So the put side was still open. Call side was closed, went into a max loss on this. And I was in that area where you get assigned, and I did get assigned a contract, a futures contract, and I closed it out right after, and still made $35 in the trade just because of the other positions that worked out. All right, so this one I started at from 4 p.m. and I got in at 6:34 p.m. on the overnight session, and it went to 8:30 the next day. And so I put on a put spread and I put on the call spread. Now this is how it should work. Bought the call spread for $1.10. It just didn't work out, but we still got some profit there, and we closed that at 95 cents. And so stayed there all day long, still got it, profitable, small profit. Okay, here's another. So put on a put spread, 9:46 a.m. And then I placed the closing trade at 10 cents. So that trade worked out really, really well. I mean, you can see this direction. It was very directional trade. Sold a put here because I figured it was going to continue moving. So we got this dip. However, it moved down and then it went back up, and I closed the trade for 45 cents, and it was at an 82.50. And so this was one contract that I did here. Okay, so on this one here, started at 7:40. So this was the overnight session again. And then I put a put spread on there, and then I put a call spread on right around the same time. I was able to close the call spread for 35 cents and close the put spread for 10 cents. And then I actually sold another put spread, and I think this was in the same contract. Yes, it was. And closed out, the position expired. On this trade, I wanted to just let it expire because we're close to the end of the day here. And it expires and it closes out the trade immediately at 4 o'clock. So it's not like SPX that you have to wait until the next day. Right. So those are the trades that I put on. And you can see that the way that I place them now is usually around 2 o'clock in the afternoon and wait till the next day to get out. And sometimes I get out. If I wake up in the middle of the night and I have a good profit, I'll close it out out. But in any case, I use alerts because you can't stop out at night in case the trade goes bad, and that way I can get out of the trade at night. So alerts do work. Hopefully you get a better understanding of how options on futures work. I am going to be focusing on this trade to get it much more profitable. And you can see the performance now in the channel. We're actually up on the year, which is good, but I really want to get that performance up. Hopefully this was of value to you guys. If you have any questions at all, just reach out and I will be there to help you out. Okay, guys, hope this was good and we'll see you next time. Thanks.